Hi everyone, I'm Karan and welcome to Karan's Gyan. In the last video, we talked about forwards agreement. We talked about the structure of the forwards contract. We talked about how parties come into an agreement. We highlighted the advantages and the risk involved in forwards agreement. So today we'll talk about futures contract. If you guys don't know what forwards agreement is, I compel you to watch the last video for you to understand this video better. Let's start. As I mentioned before, a forwards agreement had four major risks involved. The first was liquidity risk. Liquidity risk is when ABC Jewelers had to go to a bank for them to find someone who would take the opposite side of the bet. So it would have to incentivize the banks or pay them a big fat fee for them to go and find someone who would agree into an agreement with ABC Jewelers. Second one was default risk. The risk was either ABC Jewelers defaults or refuses to abide by the contract, or XYZ Jewelers, XYZ gold dealers refuses to abide by the contract. The third was regulatory risk. There was no regulator between both these parties. A regulator who would kind of guarantee the contract. A regular who would foresee if correct quality of gold is being exchanged between ABC Jewelers and XYZ gold dealers. A regulator who would also make sure that at the date of expiry, which was 1st April, XYZ gold dealers would abide by their contract and ABC gold jewelers would abide by their side of the contract. All right. And the fourth risk was the rigidity of the transitional structure. The agreement was for 3 months, and if either of the parties wanted to change their mind and come out of the agreement, the forwards agreement prevented them to do so. So that was another problem in the forwards agreement. So futures agreement is based on the traditional structure of forwards agreement, but it doesn't come with all these four risks. All right, you can take futures agreement as a car. All right, a car which has seat belt, which has ABS, which has power steering, which has airbags, but can still take you from point A to point B, similar to the traditional structure of forwards contract. Okay, what are the advantages of forwards contract? Now, other than the advantages of not having these four risks, the other advantages of futures contract is it'll mimic the underlying. So, ABC Jewelers and XYZ Gold Dealers, they came into an agreement for forwards contract of gold. All right. So, if they come into an agreement of futures contract of gold, the future value, the futures contract would mimic the value of gold. So if gold increases by 10%, gold's future contract would also increase by 10%. So it'll mimic it, it'll track it. Next is standardized contract. So standardized contract can be a basic standard. For example, there can be a 100-gram gold contract. Like 100 gram is like a standard contract. It's like a lot size. So since 100-gram gold is the standardized contract, the XYZ gold dealers and ABC jewelers would come into a contract of 100 standardized contracts or 100 lots, because I'm sorry, 10 lots, because 10 into 100 grams is 1 kg and they had a deal of 1 kg. All right. Next is future contracts are tradable. So this refers to the risk of rigidity. So they're tradable in the sense, if they have come into a contract for 3 months and after 1 month they change their mind, they can sell their position to someone else. That means ABC Jewelers can maybe sell their side of the contract to some other counterparty, to some other jeweler who wants to take that risk. All right. So they are tradable. They're highly regulated. There's a third party between them in futures contract in India there's like SEBI, Securities Exchange Board of India. It takes care that both the sides hold their part of the deal. It's a third party. It kind of guarantees that both the sides are responsible and don't cheat each other. Now, future contracts are time bound. Like I told you, forward contracts are based upon some time in the future. So there's a deal that I'll supply this amount of commodity at this price 3 months from now. So there's a time frame. So obviously, since future contracts are made upon forward contracts, even they are time bound. All right. Um, this is again a tabular form of forwards contract and futures contract. So now, yeah, I didn't mention this in the last video, but it can kind of give you a better idea. Forward contracts are traded over the counter. So now, what I mean by trading over the counter, they're not traded in a traditional market. They are traded in an unconventional market, where there are independent buyers and sellers, and there's no uniform marketplace. But futures contract is traded at an exchange where there are buyers and sellers both lined up, and there is a procedure for them to come into an agreement. So there's an exchange, and here there's over the counter. For me to explain you better is, when you go and buy dollars, you buy dollars from a money exchanger. So that guy would give you dollars over the counter, because it is his price. He says, I'll sell you dollar at 80 rupees, per dollar, and that is the price. That is over the counter. But in if there's an exchange, there'll be 10 people lined up. Somebody would say, all right, I'll sell dollar at 80 rupees. The other person would say, all right, I'll sell dollar at 79 rupees. The third person would be like, all right, I'll sell you dollar at 78 rupees 50 paisa. So that's an exchange. There's no fixed price. There are a lot of buyers, a lot of sellers. So that is an exchange. Over the counter is more like fixed price. Forward contracts are not customizable. Okay, futures contract are customizable because they're standardized, they're based on lots. Okay, high counterparty risk, I highlighted it before. No counterparty risk. There's a regulator in between who will take care, there's no risk. Futures contract, yeah, forwards are not regulated. Futures are regulated by SEBI, Securities Exchange Board of India. All right, this is in India. So in US, there would be some other board that will take care. I'm not too aware. Maybe it's SEC, which is Securities Exchange Commission. Okay, anyways, forward contracts are not transferable because, like I told you, if ABC contracts or ABC jewelers or XYZ gold dealers want to come out of the deal, they won't be able to come out of the deal. Whereas futures, like, they're tradable. You can transfer the contract to someone else who's willing to take that risk. Forward contracts, they're time bound to one time frame. Like they there's a 3 month contract between ABC gold jewelers and XYZ gold dealers. All right, but future contracts, there are multiple future contracts available. There are weekly future contracts, monthly future contracts, yearly, semi-annually, quarterly. There are multiple for various asset classes. You can go out, check out NSE website. There you can find future contracts for a lot of companies. I'll show you, like, myself in the days to come, about different futures available. All right. Okay, I talked about lot size. Yeah, like I told you, futures contract is standardized. All right, so there's a lot size to it. Okay, so lot size specifies the minimum quantity that you'll have to transact in a future contract. It's a lot size. For example, the index of Nifty 50 has a lot size of 75. All right, so for you to trade in futures contract, you'll need to buy the lots of 75 Nifty 50, like 75 shares. Like, if you buy one lot of Nifty futures, you're basically buying 75 shares of Nifty. It's like that. Contract value. Okay, so like I said, this ABC Jewelers wanted to buy 1 kg of gold from XYZ gold dealers. 1 kg was at 2,450 rupees. So the contract value is 2,450 rupees into 1,000. that is 24 lakhs 50,000 rupees. That is the contract value. So if I say lot size, lot is 100 gram. Alright, so here they would deal into 10 lots. Okay, so they would say, alright, I'll like to buy 10 lots. Let's get an agreement for 10 lots. Okay, so they'll come up with lot size into price. So this is a better explanation for you. Next is margin. So now I told you about a counterparty risk. I told you that either of the companies can say that I'm sorry, I don't think I can abide by this agreement. All right, and they can say sorry, we can't pay, we don't have money. So that is a counterparty risk we talked about. Now a regulator is also stepping in, who is trying to like mediate between both the companies, who's trying to guarantee the contract between both the companies. So the regular can't be like won't be willing to put their own money in line in case one of the parties defaults. So what does regulator say? All right, he says, ABC Gold Jewelers, you want to buy 1 kg gold 3 months from now, right? So what do? You'll buy 1 kg gold at 24 lakh 50,000 rupees. So why don't you give me a 10% token amount? Why don't you give me 2 lakh 45,000 rupees as a token amount? Because in case you don't abide by the deal, this amount won't be returned back to you. It's like a margin, it's like a guarantee. So ABC Jewelers would be would want to stick to the deal, because they'll think, I'll lose my money, I'll lose my token amount. Similarly, there is a margin to XYZ gold dealers. They'd say, all right, ABC Jewelers has given us 2,45,000 rupees. Even you have to give us 2,45,000 rupees. So that is the margin. All right. So margin is actually, it's a percentage of the contract value, as I told you. So in this case, I gave you an example of 10% contract value of 24 lakh 50,000 rupees. If you look at from a mathematical standpoint, how does how does an exchange calculate this value? Have you ever wondered? So the exchange comes up with this value based on something called how volatile is something. For example, exchange would go see the past histories. It'll see what is the maximum the price of gold would change in 3 months. All right, and they'll see the historical price change, and they'll come up with a figure. They'll say, all right, we have observed that in the past 10 years, gold price hasn't changed more than 10 to 15% in 3 months. So we'll take a margin of 10 to 15%, because, like I told you, if there's a cash settlement, they already have the token money. So margin is actually based upon the variance, the standard deviation, that how much can the price of the commodity change in 3 months. So they'll find it on the basis of that. There's actually whole maths behind it. They'll find the bell curve about the historic returns in the past 10 years, how much gold has changed in the past 3 months, like in the intervals of 3 months for the past 10 years. They'll come up with the variation, and they'll find a bell curve. They'll take a confidence interval, that already will take a confidence interval between plus minus 90%, and whatever the interval tells us, that will be the margin amount. So this is the calculation behind it. That is for some other day. I'll be coming to that in the future, but long way from here. But just so that you know. And expiry, I explained you expiry before. Expiry is when the contract expires. So XYZ gold dealers and ABC jewelers, they came into a contract of 3 months. After 3 months, they have no contract anymore. So it doesn't matter what is the price of gold after 3 months. There's an expiry. They're time bound. I told you forward contracts are based upon a timeline, because after this date you'll give us this much money. So that is the timeline. right? So there's an expiry date to it. There are monthly expiry contracts, weekly, yearly, quarterly, semi-annually, daily, hourly. There are a lot of expiries, right? So so this is more or less about futures contract. In the next video, I'll be talking about how futures change according to change in the price of the underlying. That means how would the price of gold futures change according to the price of gold. All right, so guys, stay tuned. If you like the video, please press the like button. If you want this PDF, I can email it to you or give it to you. Just ask me. If you guys have any questions, please comment. And if you guys want to like see more of these videos coming up, please subscribe. Thank you very much. Have a nice day.